The NMLS SAFE Mortgage Loan Originator Exam, 110 practice questions with answers and explanations, covering federal mortgage law, uniform state content, loan products, origination, and ethics. After each question, pause and pick your answer before the reveal. Let's begin. Question 1. A title company gives an MLO a $75 gift card for each closed loan. The MLO refers to it. Both parties argue no cash changed hands and the amount is small. Under RESPA, this arrangement is A. A prohibited kickback, because a thing of value was given for the referral of settlement service business. B. Permitted, because non-cash items of nominal value are exempt from Section 8. C. Permitted, so long as the arrangement is disclosed on the closing disclosure. D. Permitted, because the title company is not the creditor on the loan.
The answer is A. A prohibited kickback, because a thing of value was given for the referral of settlement service business. RESPA Section 8. A bars giving or accepting any fee, kickback, or thing of value pursuant to an agreement or understanding that business incident to a real estate settlement service be referred.
Question 2. A mortgage brokerage refers borrowers to a title agency in which the brokerage's owner holds a 40% interest. Which set of conditions must be satisfied for this affiliated business arrangement to fall within RESPA exception? A. Written disclosure within 3 business days after the referral and a fee split of no more than 50%. B. Written disclosure of the relationship at or before the referral, no required use of the affiliate, and the only return is a return on the ownership interest. C. Disclosure on the closing disclosure and written consent from the consumer at consummation. D. Approval of the arrangement by the state regulator and disclosure of the owner's percentage interest to the CFPB.
The answer is B. Written disclosure of the relationship at or before the referral, no required use of the affiliate, and the only return is a return on the ownership interest. RESPA affiliated business arrangement exception is conditional. The referring party must give a written ABA disclosure at or before the time of referral describing the relationship and estimated charges, must not require the consumer to use the affiliate aside from narrow exceptions such as attorney or lender selection of its own representative, and may receive nothing beyond a return on its ownership interest.
Question 3. In a residential purchase transaction, the seller conditions acceptance of the buyer's offer on the buyer purchasing title insurance from a title company the seller names. Which statement is correct? A. This is permitted if the seller pays for the title policy. B. This is permitted if the designated title company's rates are competitive. C. This violates RESPA Section 9, and the seller is liable to the buyer for 3 times all charges made for the title insurance. D. This violates RESPA Section 8, and the penalty is limited to a refund of the premium.
The answer is C. This violates RESPA Section 9, and the seller is liable to the buyer for 3 times all charges made for the title insurance. RESPA Section 9 prohibits a seller from requiring, directly or indirectly, that the buyer purchase title insurance from any particular title company as a condition of sale.
Question 4. Under RESPA escrow account rules, the servicer must deliver the initial escrow account statement at settlement, or, if not delivered then, within A. 60 calendar days of the first payment due date. B. 30 calendar days of settlement. C. 45 business days of settlement. D. 45 calendar days of settlement.
The answer is D. 45 calendar days of settlement. Regulation X requires the initial escrow account statement at settlement or within 45 calendar days of settlement. The rule is written in calendar days, not business days, and many circulating study decks state this incorrectly.
Question 5. A borrower's loan servicing is being transferred to a new servicer. Which combination of RESPA servicing transfer requirements is correct? A. Notice from either servicer within 30 days after the transfer and a 90-day grace period for misdirected payments. B. Transferee notice at least 15 days before the effective date and a 15-day grace period for misdirected payments. C. Transferor notice at least 30 days before the effective date and a 30-day period during which no late fee may be imposed. D. Transferor notice at least 15 days before the effective date, transferee notice within 15 days after, and a 60-day period during which a payment sent to the old servicer cannot trigger a late fee.
The answer is D. Transferor notice at least 15 days before the effective date, transferee notice within 15 days after, and a 60-day period during which a payment sent to the old servicer cannot trigger a late fee. RESPA Section 6 requires the transferring servicer to notify the borrower at least 15 days before the effective transfer date, and the new servicer to notify within 15 days after it.
Question 6. A borrower sends the servicer a written notice asserting that a payment was misapplied. Under Regulation X's error resolution procedures, the servicer must A. Respond within 30 calendar days with no acknowledgement required. B. Acknowledge within 5 calendar days and respond within 45 calendar days. C. Acknowledge the notice within 5 business days and respond within 30 business days, with one permitted 15 business day extension. D. Acknowledge within 20 business days and respond within 60 business days.
The answer is C. Acknowledge the notice within 5 business days and respond within 30 business days, with one permitted 15 business day extension. Regulation X's Notice of Error Framework gives the servicer 5 business days to acknowledge receipt in writing and 30 business days to investigate and respond, either correcting the error or explaining why no error occurred.
Question 7. Under TRID, which of the following, taken together, constitute an application that starts the loan estimate clock? A. Name, income, social security number, property address, estimated property value, and loan amount sought. B. Name, income, social security number, property address, estimated value, loan amount, and any other information the creditor deems necessary. C. Assigned uniform residential loan application together with the credit report fee. D. Name, income, credit score, property address, purchase price, and down payment.
The answer is A. Name, income, social security number, property address, estimated property value, and loan amount sought. TRID defines an application as exactly 6 pieces of information: the consumer's name, income, social security number to obtain a credit report, the property address, an estimate of the property's value, and the mortgage loan amount sought.
Question 8. A consumer submits a complete application on Monday. Consummation is scheduled soon. Which pair of TRID deadlines applies to the loan estimate? A. Delivered or placed in the mail no later than 3 business days after application, and received no later than 7 business days before consummation. B. Delivered no later than 7 business days after application, and received no later than 3 business days before consummation. C. Delivered no later than 3 business days after application, and received no later than 3 business days before consummation. D. Delivered at or before consummation, with no minimum waiting period.
The answer is A. Delivered or placed in the mail no later than 3 business days after application, and received no later than 7 business days before consummation. Wait, the correct rule is the 3-day delivery, plus a 7 business day wait before consummation.
Question 9. Which change occurring after the consumer has received the closing disclosure requires the creditor to provide a corrected disclosure and a new 3 business day waiting period? A. The loan product changes from a fixed rate to an adjustable rate. B. The seller agrees to pay an additional $500 toward closing costs. C. The recording fee increases by $85. D. The borrower's homeowner's insurance premium comes in higher than estimated.
The answer is A. The loan product changes from a fixed rate to an adjustable rate. Only 3 changes restart the 3-business-day waiting period. The disclosed APRA becomes inaccurate, the loan product changes, or a prepayment penalty is added.
Question 10. Under TRID good faith variation rules, which charge falls into the zero tolerance category? A. A recording fee. B. A transfer tax. C. Prepaid interest. D. The premium for hazard insurance the consumer selects.
The answer is B. A transfer tax. Transfer taxes sit in the zero tolerance bucket along with creditor and broker fees, fees paid to a creditor affiliate, and fees for services the consumer cannot shop for. These amounts may not increase at all from the loan estimate.
Question 11. A creditor discovers 20 days after consummation that it exceeded the 10% cumulative tolerance. To cure the violation, the creditor must refund the excess and deliver a corrected closing disclosure no later than A. 3 business days after discovering the error. B. 60 calendar days after consummation. C. 30 calendar days after consummation. D. At the next annual escrow analysis.
The answer is B. 60 calendar days after consummation. Regulation Z allows a creditor to cure a tolerance violation by refunding the excess to the consumer and delivering a corrected closing disclosure within 60 calendar days after consummation.
Question 12. Which of the following transactions carries a right of rescission under Regulation Z? A. A loan to an LLC secured by a 4-unit rental building. B. A purchase money first mortgage on the borrower's principal residence. C. A refinance of a vacation home the borrower occupies 2 months a year. D. A cash-out refinance with a new lender secured by the borrower's principal residence.
The answer is D. A cash-out refinance with a new lender secured by the borrower's principal residence. The right of rescission attaches when a non-purchase money lien is placed on the consumer's principal dwelling, so a cash-out refinance with a new creditor is rescindable.
Question 13. For purposes of counting the 3-day rescission period, which day is not counted as a business day? A. Sunday. B. Saturday. C. A Monday when the creditor's office is closed for staff training. D. The day the consumer signs the note.
The answer is A. Sunday. For rescission, the 7-business-day loan estimate wait and the 3-business-day closing disclosure receipt rule, Regulation Z uses the precise definition: all calendar days except Sundays and the 10 federal legal public holidays.
Question 14. A borrower refinanced her principal residence, but was never given the required notice of the right to rescind. What is the effect on her rescission rights, and what must the creditor do once she rescinds? A. The rescission period is unlimited, and the creditor must respond within 60 calendar days. B. The rescission period extends to 1 year, and the creditor must respond within 30 calendar days. C. The rescission right is lost after closing, but the borrower may recover statutory damages. D. The rescission period extends to 3 years from consummation, and within 20 calendar days of receiving the notice of rescission, the creditor must return money and release the security interest.
The answer is D. The rescission period extends to 3 years from consummation, and within 20 calendar days of receiving the notice of rescission, the creditor must return money and release the security interest. If the creditor fails to deliver the rescission notice or the material disclosures, the 3 business day period expands to 3 years from consummation, or until the property is sold or transferred, whichever comes first.
Question 15. Which of the following fees is not included in the finance charge on a mortgage loan? A. The private mortgage insurance premium. B. Discount points paid by the borrower to reduce the rate. C. Per diem interest collected at closing. D. The title insurance premium and closing agent fee.
The answer is D. The title insurance premium and closing agent fee. The finance charge is the cost of consumer credit as a dollar amount, so it captures charges imposed by the creditor as an incident to the extension of credit, discount points, prepaid interest, and mortgage insurance premiums all qualify.
Question 16. A radio ad for a fixed-rate mortgage states, "Own a home for just $1,450 a month." Under Regulation Z's advertising rules, this ad must also disclose A. The interest rate, the total of payments, and the amount financed. B. The amount or percentage of the down payment, the terms of repayment, and the annual percentage rate. C. Only the annual percentage rate. D. The lender's NMLS unique identifier and the total finance charge.
The answer is B. The amount or percentage of the down payment, the terms of repayment, and the annual percentage rate. Stating the amount of any payment is a trigger term in a closed-end credit ad, along with the amount or percentage of a down payment, the number of payments or period of repayment, and the amount of any finance charge.
Question 17. A loan is classified as a high-cost mortgage under HOEPA. Which requirement or prohibition applies? A. The loan must be sold to a government-sponsored enterprise within 90 days. B. A second appraisal is required whenever the property was recently resold at a higher price. C. An escrow account must be maintained for at least 5 years, but prepayment penalties remain permitted. D. The borrower must receive homeownership counseling from a HUD-approved counselor before the loan is made, and prepayment penalties are prohibited.
The answer is D. The borrower must receive homeownership counseling from a HUD-approved counselor before the loan is made, and prepayment penalties are prohibited. Once any one of HOEPA 3 triggers APRA spread, points and fees, or prepayment penalty is crossed, the loan becomes a high-cost mortgage and a package of restrictions attaches. Mandatory pre-loan counseling from a HUD-approved counselor, plus bans on prepayment penalties, balloon payments with narrow exceptions, negative amortization, financing points and fees, default interest rate increases, and recommending default.
Question 18. Under Regulation Z's loan originator compensation rule, which basis for paying an individual loan originator is permitted? A. Extra compensation for loans that include a prepayment penalty. B. A higher commission when the loan-to-value ratio exceeds a set level. C. A bonus that increases with the interest rate on each closed loan. D. A fixed percentage of the loan amount applied consistently across transactions.
The answer is D. A fixed percentage of the loan amount applied consistently across transactions. Regulation Z forbids compensating a loan originator based on a term of the transaction or any proxy for a term. The interest rate, the presence of a prepayment penalty, and the loan-to-value ratio are all transaction terms.
Question 19. A married applicant qualifies for the mortgage on her own income and credit. The MLO tells her the lender still requires her husband to sign the note. Under ECOA, this is A. Permitted, because both spouses will live in the property. B. A violation, only if the couple lives in a community property state. C. A violation, because a creditor may not require a spouse's signature when the applicant qualifies independently under the creditor's standards. D. Permitted, because the lender may require any additional signature it considers prudent.
The answer is C. A violation because a creditor may not require a spouse's signature when the applicant qualifies independently under the creditor's standards. Regulation B prohibits requiring the signature of an applicant's spouse or other person on a credit instrument when the applicant qualifies on her own under the creditor's standards of creditworthiness.
Question 20. Which protected class is covered by the Equal Credit Opportunity Act, but is not one of the classes protected by the Federal Fair Housing Act? A. National origin. B. Familial status. C. Receipt of income from a public assistance program. D. Disability.
The answer is C. Receipt of income from a public assistance program. HOEPA prohibited bases include race, color, religion, national origin, sex, marital status, age, receipt of public assistance income, and the good faith exercise of rights under the Consumer Credit Protection Act.
Question 21. An MLO tells a borrower whose loan was denied that she will get the reasons sometime after closing season. Under HOEPA, notice of action taken on a completed application must be given within A. 90 days after receiving the completed application. B. 30 days after receiving the completed application. C. 15 days after the credit decision. D. 60 days after the application date.
The answer is B. 30 days after receiving the completed application. Regulation B requires notification of action taken within 30 days after receiving a completed application, and the same 30-day clock applies to adverse action on an existing account and to a counteroffer the applicant does not accept.
Question 22. An MLO reviewing a file notices a series of $9,500 cash deposits made on consecutive days and suspects the borrower is breaking up a larger sum. After the company files a SAR, may the MLO tell the borrower: A. No, a SAR and its existence are confidential, and disclosing them to the subject is prohibited. B. Yes, if the borrower asks directly, and the MLO documents the conversation. C. Yes, because the borrower has a right to know what is in his own file. D. Only after the 30-day filing deadline has passed.
The answer is A. No, a SAR and its existence are confidential, and disclosing them to the subject is prohibited. The Bank Secrecy Act makes a suspicious activity report, and any information revealing its existence strictly confidential. Tipping off the subject is itself a violation and would defeat the report's law enforcement purpose.
Question 23. An individual paid by a mortgage brokerage speaks with consumers and offers and negotiates interest rates and terms on loans secured by their primary residences, but she never takes the applications. A licensed colleague does that. Under the SAFE Act and the model state law, must she hold a state MLO license? A. Yes, the definition is met by taking an application or offering or negotiating terms, so negotiating a loan requires a license. B. No, only the individual who signs the application, as the originator needs a license. C. Yes, but only if she is paid by commission rather than by salary. D. No, an individual must both take the application and offer or negotiate terms to be a mortgage loan originator.
The answer is A. Yes. The definition is met by taking an application or offering or negotiating terms, so negotiating a loan requires a license. The statutory definition of mortgage loan originator is disjunctive. An individual who, for compensation or gain or in the expectation of compensation or gain, takes a residential mortgage loan application or offers or negotiates terms of a residential mortgage loan.
Question 24. For purposes of the SAFE Act's education requirements, which of the following is a non-traditional mortgage product? A. Only adjustable rate, interest-only, and payment option loans. B. Any residential loan that cannot be sold to a government-sponsored enterprise. C. Any residential loan that carries a prepayment penalty. D. A 15-year fixed-rate mortgage.
The answer is D. A 15-year fixed-rate mortgage. The SAFE Act defines a non-traditional mortgage product as any mortgage product other than a 30-year fixed-rate mortgage.
Question 25. An individual works from home as an independent contractor for a licensed mortgage company, performing only loan processing, collecting and verifying documents after applications are received. What is his licensing status? A. He must obtain a state MLO license, because the processor/underwriter exclusion covers only supervised employees, not independent contractors. B. Exempt, but he must register with NMLS for a unique identifier without obtaining a license. C. Exempt, as long as he never discusses rates or terms with borrowers. D. Exempt, because he performs only clerical and support duties after an application is received.
The answer is A. He must obtain a state MLO license because the processor/underwriter exclusion covers only supervised employees, not independent contractors. The loan processor/underwriter exclusion applies only to an individual who performs clerical or support duties as an employee at the direction of, and subject to the supervision and instruction of a licensed or exempt person. The SAFE Act separately provides that an independent contractor may not engage in residential mortgage loan processing or underwriting unless he obtains and maintains a state MLO license.
Question 26. A licensed real estate agent helps her buyer client and, in the same transaction, discusses loan products and terms with the buyer. The lender pays her a fee for that assistance. What is her licensing status? A. She is exempt. Holding a real estate license always exempts a person from MLO licensing. B. She must be licensed as an MLO. The real estate brokerage exclusion is lost when the person is compensated by a lender, mortgage broker, or other loan originator. C. She is exempt as long as the lender's payment is disclosed to the buyer in writing. D. She is exempt because negotiating contract terms is part of real estate brokerage activity.
The answer is B. She must be licensed as an MLO. The real estate brokerage exclusion is lost when the person is compensated by a lender, mortgage broker, or other loan originator. The MLO definition excludes a person who performs only real estate brokerage activity and is licensed or registered as a real estate broker or agent. But that exclusion expressly does not apply if the person is compensated by a lender, a mortgage broker, another loan originator, or any agent of theirs.
Question 27. Which of the following loan originators must obtain a state MLO license rather than being federally registered? A. A loan originator employed by an institution regulated by the Farm Credit Administration. B. A loan originator employed by a federally insured depository institution. C. A loan originator employed by a depository-owned subsidiary that is regulated by a federal banking agency. D. A loan originator employed by an independently owned, non-depository mortgage brokerage.
The answer is D. A loan originator employed by an independently owned, non-depository mortgage brokerage. The SAFE Act creates a two-track system. Employees of depository institutions, of depository-owned subsidiaries regulated by a federal banking agency, and of Farm Credit Administration regulated institutions are federally registered, while everyone else originating residential mortgage loans must be state licensed.
Question 28. Under the model state law adopted by the states, where must a state-licensed MLO's unique identifier be shown? A. Only when a consumer asks for it, and in the originator's first written communication with the consumer. B. On residential mortgage loan application forms, solicitations, and advertisements, including business cards and websites. C. Only on advertisements that quote a specific interest rate. D. Only on the promissory note and security instrument signed at closing.
The answer is B. On residential mortgage loan application forms, solicitations, and advertisements, including business cards and websites. The model state law's unique identifier shown provision requires that the identifier of any person originating a residential mortgage loan be clearly shown on all residential mortgage loan application forms, solicitations, and advertisements, expressly including business cards and websites, plus any other document the Commissioner designates.
Question 29. An applicant's MLO license application has been approved by the state regulator, but her employing company has not yet completed the sponsorship in NMLS. May she begin originating loans? A. No, an approved but unsponsored license is inactive, and origination may not begin until the employer's sponsorship is in place. B. Yes, approval of the application is what authorizes origination. C. Yes, for up to 30 days, provided a licensed MLO supervises her work. D. Yes, provided she uses the company's unique identifier until the sponsorship posts.
The answer is A. No, an approved but unsponsored license is inactive, and origination may not begin until the employer's sponsorship is in place. A license authorizes origination only while the originator is employed by and sponsored by a licensed company. So an approved license with no sponsorship sits in an approved inactive status, and no origination may occur.
Question 30. An applicant for an MLO license was convicted of felony wire fraud 12 years ago. How does the SAFE Act criminal history standard treat him? A. He is permanently barred. A felony involving fraud, dishonesty, breach of trust, or money laundering disqualifies an applicant at any time, with no 7-year cure. B. He is eligible 10 years after the conviction, once the sentence has been fully served. C. He is eligible if he can otherwise demonstrate financial responsibility, character, and general fitness. D. He is eligible because more than 7 years have passed since the conviction.
The answer is A. He is permanently barred. A felony involving fraud, dishonesty, breach of trust, or money laundering disqualifies an applicant at any time, with no 7-year cure. The minimum standards for issuance bar an applicant who has been convicted of, or pled guilty, or nolo contendere to, a felony during the 7-year period preceding the application, and at any time preceding the application if the felony involved an act of fraud, dishonesty, a breach of trust, or money laundering.
Question 31. An applicant pled nolo contendere 5 years ago to a felony that had nothing to do with fraud or money. She has otherwise clean credit and strong references. What is the result under the SAFE Act minimum standards? A. She is not eligible now. Any felony conviction or guilty/nolo plea within the 7 years preceding the application disqualifies an applicant. B. She is eligible because only fraud-related felonies affect MLO licensing. C. She is permanently barred from ever holding an MLO license. D. She is eligible because a plea of nolo contendere is not a conviction.
The answer is A. She is not eligible now. Any felony conviction or guilty/nolo plea within the 7 years preceding the application disqualifies an applicant. The statute expressly reaches a conviction, a plea of guilty, and a plea of nolo contendere to a felony in any domestic, foreign, or military court during the 7-year period preceding the application, regardless of the felony's subject matter.
Question 32. In reviewing an applicant's credit report, which single item, standing alone, does not indicate a failure to meet the financial responsibility standard? A. A current outstanding judgment that arises solely from unpaid medical expenses. B. A pattern of seriously delinquent accounts within the past 3 years. C. A completed foreclosure 2 years ago. D. A current outstanding federal tax lien.
The answer is A. A current outstanding judgment that arises solely from unpaid medical expenses. The financial responsibility standard asks whether the applicant's record commands the confidence of the community and warrants a determination that the originator will operate honestly, fairly, and efficiently. And the enumerated warning signs are outstanding judgments, outstanding tax or other government liens, foreclosures within the past 3 years, and a pattern of seriously delinquent accounts within the past 3 years.
Question 33. What is the minimum pre-licensing education the SAFE Act requires of a state-licensed MLO applicant? A. 20 hours, including 3 hours of federal law, 2 hours of ethics, and 2 hours of non-traditional mortgage products. B. 20 hours, including 3 hours of federal law and regulations, 3 hours of ethics, and 2 hours of non-traditional mortgage product lending. C. 20 hours, including 5 hours of federal law and 5 hours of ethics, with no non-traditional product requirement. D. 8 hours, including 3 hours of federal law, 2 hours of ethics, and 2 hours of non-traditional mortgage products.
The answer is B. 20 hours, including 3 hours of federal law and regulations, 3 hours of ethics, and 2 hours of non-traditional mortgage product lending. The federal floor for pre-licensing education is at least 20 hours of NMLS-approved coursework that must include at least 3 hours of federal law and regulations, at least 3 hours of ethics covering fraud, consumer protection, and fair lending, and at least 2 hours of training on lending standards for the non-traditional mortgage product marketplace. The 3-3-2 within 20.
Question 34. What continuing education does the SAFE Act require of a state-licensed MLO each year? A. 8 hours, including 3 hours of federal law, 2 hours of ethics, and 2 hours of non-traditional mortgage products. B. 8 hours, including 3 hours of federal law, 3 hours of ethics, and 2 hours of non-traditional mortgage products. C. 8 hours of any NMLS-approved content, with no required subject breakdown. D. 20 hours, including 3 hours of federal law, 2 hours of ethics, and 2 hours of non-traditional mortgage products.
The answer is A. 8 hours, including 3 hours of federal law, 2 hours of ethics, and 2 hours of non-traditional mortgage products. Annual continuing education must be at least 8 hours of NMLS-approved coursework, including at least 3 hours of federal law and regulations, at least 2 hours of ethics fraud, consumer protection, fair lending, and at least 2 hours on non-traditional mortgage products. The 3-2-2 within 8, leaving 1 undefined elective hour.
Question 35. A licensed MLO completed a particular NMLS-approved 8-hour continuing education course last year and wants to take the identical course again this year to satisfy the requirement. What is the result? A. Allowed if the identical course is purchased from a different NMLS-approved provider. B. Allowed, credit is granted in each year the course is completed, regardless of repetition. C. Not allowed. An originator may not receive credit for the same approved course taken in the same or successive years. D. Allowed if the originator also teaches the course, since instructors receive credit.
The answer is C. Not allowed. An originator may not receive credit for the same approved course taken in the same or successive years. The successive years rule bars an originator from receiving continuing education credit for the same approved course taken in the same or successive years, which forces the curriculum to refresh. Credit is also granted only in the year the course is actually taken, so hours cannot be banked forward.
Question 36. A candidate scores 72% on the national test component, his third consecutive failure. Which statement is correct? A. He failed, but as with his earlier attempts, he may retest after 30 days. B. He failed, and, after 3 consecutive failures, is permanently ineligible to sit for the test again. C. He passed. 72% meets the national standard, so no retest is needed. D. He failed, at least 75% correct is required. And after 3 consecutive failures, he must wait at least 6 months to retest.
The answer is D. He failed, at least 75% correct is required, and after 3 consecutive failures, he must wait at least 6 months to retest. An individual passes the qualified written test only by answering not less than 75% of the questions correctly.
Question 37. An originator let his state MLO license lapse and then worked for 6 years as a federally registered MLO at a bank. He now applies for a state license again. Must he retake the national test? A. No retest is required. Time spent as a federally registered MLO does not count toward the 5-year lapse period. B. He must retake the test, because more than 5 years passed without a state license. C. He must retake the test and repeat the 20 hours of pre-licensing education. D. He must retake the test only if more than 3 years passed without a state license.
The answer is A. No retest is required. Time spent as a federally registered MLO does not count toward the 5-year lapse period. Test results expire when an individual fails to maintain a valid license for a period of 5 years or longer. But the statute expressly excludes from that calculation any time during which the individual was a registered loan originator.
Question 38. Which set of conditions must a state-licensed MLO satisfy for the license to be renewed for the next annual term? A. Paying the renewal fee only. Continuing education hours may be carried forward from an earlier year. B. Continuing to meet the minimum standards for issuance, satisfying the annual continuing education requirement, and paying all required fees. C. Repeating the 20 hours of pre-licensing education each year. D. Retaking and passing the national test component each year.
The answer is B. Continuing to meet the minimum standards for issuance, satisfying the annual continuing education requirement, and paying all required fees. Renewal is a fresh confirmation of ongoing eligibility. The originator must continue to meet the minimum standards for issuance, no revocation, the felony standards, financial responsibility, character and general fitness, and the state's bond, net worth or recovery fund requirement, must have satisfied the annual continuing education requirement and must have paid all required fees.
Question 39. A newly licensed originator asks how large a surety bond he must carry. What is the accurate answer? A. It varies by state. The SAFE Act requires a net worth, surety bond, or state recovery fund contribution, and each state chooses which one and sets the amount, so he must consult that state's requirements. B. A single national minimum bond amount fixed by the SAFE Act applies in every state. C. The requirement applies only to mortgage companies. Individual originators are never covered. D. Every state requires all 3: a minimum net worth, a surety bond, and a recovery fund payment.
The answer is A. It varies by state. The SAFE Act requires a net worth, surety bond, or state recovery fund contribution, and each state chooses which one and sets the amount, so he must consult that state's requirements. The SAFE Act sets a minimum standard in concept only. An applicant must have met a net worth or surety bond requirement, or paid into a state recovery fund, as required by the state loan originator supervisory authority.
Question 40. To generate incoming calls, an originator advertises a specific rate and points combination that his company cannot actually deliver. Under the model state law's prohibited acts, this is A. Prohibited. An originator may not solicit, advertise, or contract for specific interest rates, points, or other financing terms unless those terms are actually available at the time. B. Permitted, because the advertisement carries the disclaimer rate subject to change without notice. C. Permitted, so long as consumers are quoted the real terms before they complete an application. D. Permitted, because the company's and the originator's unique identifiers appear in the advertisement.
The answer is A. Prohibited. An originator may not solicit, advertise, or contract for specific interest rates, points, or other financing terms unless those terms are actually available at the time. The model state law's prohibited acts expressly forbid soliciting, advertising, or entering into a contract for specific interest rates, points, or other financing terms unless the terms are actually available at the time of solicitation, advertisement, or contract. The bait-and-switch prohibition.
Question 41. During an examination, a licensee refuses to produce loan files and an employee later destroys some records. Which statement best describes the state regulator's authority? A. Only the Federal Bureau may act against a state-licensed company. The state regulator's role ends with a referral. B. The regulator may suspend or revoke the license, but has no authority to order restitution or impose monetary penalties. C. The regulator must obtain a court order before any records can be compelled and may take no action until a judge rules. D. The commissioner may compel and take possession of records, subpoena witnesses and documents, interview officers and employees, and issue cease and desist orders, restitution orders, civil money penalties, and bars from employment, and withholding or destroying records is itself a violation.
The answer is D. The commissioner may compel and take possession of records, subpoena witnesses and documents, interview officers and employees, and issue cease and desist orders, restitution orders, civil money penalties and bars from employment, and withholding or destroying records is itself a violation. The model state law gives the commissioner broad examination and investigation powers, access to books, accounts, records, files, and documents, the right to interview officers, principals, originators, and employees, subpoena authority, and the power to control access to or take possession of records where there are reasonable grounds to believe they may be altered or destroyed, plus an enforcement toolkit of cease and desist orders, restitution, civil money penalties, license denial, suspension, revocation or conditioning, and orders removing and banning individuals.
Question 42. Midway through a license year, a licensed MLO is convicted of a misdemeanor theft charge and also moves to a new home address. What does the SAFE Act-based state law require? A. She must amend her NMLS filing to disclose both changes promptly, generally within 30 days, and the conviction will also be reviewed at renewal. B. Only the conviction must be reported. Address changes are reported by the employer on its mortgage call report. C. Neither item must be reported until the annual renewal period. D. The employing company's quarterly mortgage call report satisfies her individual duty to report.
The answer is A. She must amend her NMLS filing to disclose both changes promptly, generally within 30 days, and the conviction will also be reviewed at renewal. An originator's NMLS record must be kept current, so material changes, legal name or address, criminal charges and convictions, regulatory or civil actions, financial disclosures and employment changes must be amended in the individual filing, commonly within 30 days, and the individual must attest to the accuracy of the filing even when the employer submits it.
Question 43. A federally registered MLO at a bank accepts a job with a state-licensed mortgage company in a state where she has never been licensed. What must be true for her to use temporary authority to originate while her application is pending? A. She must have been registered in NMLS as a federally registered MLO continuously during the one-year period preceding the application, be employed and sponsored by a state-licensed company in that state, and have submitted her application there. B. She must have been registered continuously during only the 30-day period preceding the application. C. Nothing more than submitting the application. Temporary authority is automatic for every applicant. D. She must first pass the national test and complete the 20 hours of pre-licensing education, after which temporary authority is granted for 120 days.
The answer is A. She must have been registered in NMLS as a federally registered MLO continuously during the one-year period preceding the application, be employed and sponsored by a state-licensed company in that state, and have submitted her application there. Temporary authority has two eligibility paths with deliberately different time periods. A federally registered originator must have been registered through NMLS continuously during the one-year period preceding the application, while an originator already licensed in another state needs only continuous licensure during the 30-day period preceding the application.
Question 44. When does an originator's period of temporary authority to operate end? A. Exactly 120 days after the application is submitted in every case. B. At midnight on December 31 of the year in which the application was submitted. C. When the originator passes the national test component. D. At the earliest of withdrawal of the application, denial or notice of intent to deny by the state granting the license, or 120 days after submission if the application is listed as incomplete.
The answer is D. At the earliest of withdrawal of the application, denial or notice of intent to deny by the state granting the license, or 120 days after submission if the application is listed as incomplete. Temporary authority begins on the date an eligible individual submits the application in the new state and ends on the earliest of four events. The individual withdraws the application, the state denies it or issues a notice of intent to deny, the state grants the license, or 120 days pass after submission where the application is listed as incomplete.
Question 45. A loan officer is comparing government loan programs for a client. Which statement correctly describes how these programs protect the lender? A. Both FHA and VA ensure 100% of the outstanding loan balance against borrower default. B. USDA Section 502 guaranteed loans are insured by HUD in the same manner as FHA loans. C. FHA insures the loan with premiums paid by the borrower into an FHA insurance fund, while VA guarantees the lender against loss on a portion of the loan. D. VA insures the loan and FHA guarantees a portion of it. USDA provides neither insurance nor a guarantee.
The answer is C. FHA insures the loan with premiums paid by the borrower into an FHA insurance fund, while VA guarantees the lender against loss on a portion of the loan. The programs differ structurally. FHA collects an upfront and an annual mortgage insurance premium into its insurance fund and insures the lender against loss, while VA charges a one-time funding fee and guarantees only a portion of the loan, the veteran's entitlement, rather than insuring it, which is why a VA loan carries no monthly mortgage insurance.
Question 46. A veteran sells her home to a buyer who will assume her existing VA-guaranteed loan with the approval of the lender and VA. Her credit score is 742 and the loan is current. What must occur for the seller's VA entitlement to be freed for use on a future home? A. A release of liability by itself restores the seller's entitlement. B. The buyer must be an eligible veteran who substitutes his or her own entitlement for the seller's, in addition to the seller obtaining a release of liability. C. VA automatically restores the seller's entitlement 12 months after any approved assumption. D. The loan must be paid in full at closing, because VA-guaranteed loans may not be assumed.
The answer is B. The buyer must be an eligible veteran who substitutes his or her own entitlement for the seller's, in addition to the seller obtaining a release of liability. VA loans are assumable with lender/VA approval, but two separate things are at stake. A release of liability protects the seller from debt liability, while only substitution of entitlement by an eligible veteran buyer moves the guarantee onto the buyer's entitlement and frees the seller's.
Question 47. A first-time buyer with a 680 credit score asks about the USDA Section 502 guaranteed program. Which pair of requirements is characteristic of that program and distinguishes it from FHA and conventional financing? A. The property must be located in a USDA-designated eligible rural area, and total household income must fall within the program's area-based income limit. B. The borrower must make a minimum down payment, and only the income of the borrowers on the note is counted. C. The borrower must be a first-time homebuyer, and the property must be located in a rural area. D. The property may be a second home located anywhere, as long as the borrower's income qualifies.
The answer is A. The property must be located in a USDA-designated eligible rural area, and total household income must fall within the program's area-based income limit. USDA Section 502, guaranteed eligibility, is driven by two screens no other major program uses together. The subject property must sit in an area USDA has designated as eligible rural, and the adjusted annual income of the entire household, including adult members who are not on the loan, must be at or below the applicable area income limit.
Question 48. On an FHA purchase, the contract price is $310,000 and the appraised value is $300,000. The base loan amount is $289,500, and the borrower elects to finance the upfront mortgage insurance premium of $5,066, producing a total loan amount of $294,566. The borrower's credit score is 690. What is the loan-to-value ratio for FHA purposes? A. 96, 5%. B. 98, 2%. C. 95, 0%. D. 93, 4%.
The answer is A. 96, 5%. FHA computes LTV as the base loan amount divided by the adjusted value, which is the lesser of the contract price or the appraised value, and financed UFMIP is expressly excluded from the numerator.
Question 49. A borrower has a conventional loan with borrower-paid private mortgage insurance. The original value was $400,000, and the original loan amount was $360,000. The borrower is current on payments, and there are no subordinate liens. Under the Homeowners Protection Act, when must the servicer terminate the PMI automatically, without any request from the borrower? A. When the balance reaches 80% of the original value, but only if the borrower submits a written request. B. When the loan balance is scheduled to reach 78% of the original value under the original amortization schedule, provided the borrower is current. C. Never. Private mortgage insurance on a conventional loan remains for the life of the loan. D. Only when a new appraisal shows the balance is 78% of the current market value.
The answer is B. when the loan balance is scheduled to reach 78% of the original value under the original amortization schedule, provided the borrower is current. The HPA sets two different triggers that candidates often blend together. The borrower may request cancellation at 80% of original value in writing, current, good payment history, no subordinate liens, but the servicer must automatically terminate at 78% of original value measured by the original amortization schedule, not by a new appraisal, with a final termination backstop at the midpoint of the amortization period.
Question 50. All of the following loan features are permitted in a general qualified mortgage, except A. A rate that is fixed for 5 years and then adjusts, with regular fully amortizing payments throughout. B. A fixed rate with monthly escrow for taxes and insurance. C. A 30-year fully amortizing term. D. A payment feature that permits negative amortization.
The answer is D. A payment feature that permits negative amortization. Regulation Z bars certain risky features from any qualified mortgage. Negative amortization, interest-only periods, balloon payments outside narrow small creditor/rural exceptions, and terms longer than 30 years.
Question 51. A borrower requests a $410,000 loan on a condominium that project review shows is non-warrantable and qualifies using 24 months of personal bank statements rather than tax returns. The loan amount is below the applicable conforming loan limit for the county. How is this loan best classified? A. Conventional and conforming, since neither the documentation type nor the condominium project affects conformity. B. Conforming, because the loan amount is below the conforming loan limit for the county. C. Jumbo, because any loan that cannot be delivered to Fannie Mae or Freddie Mac is by definition a jumbo loan. D. Nonconforming, because it fails GSE eligibility criteria. A loan can be nonconforming for reasons other than size, and jumbo refers only to loan amounts above the applicable conforming limit.
The answer is D. Nonconforming, because it fails GSE eligibility criteria. A loan can be nonconforming for reasons other than size, and jumbo refers only to loan amounts above the applicable conforming limit. Conforming means the loan meets all GSE eligibility requirements: loan amount, credit, documentation, and property. So failing any single one of them makes the loan non-conforming.
Question 52. A self-employed borrower is approved for an owner-occupied loan that uses bank statement income and includes a 10-year interest-only period, making it a non-QM loan. Which statement about the lender's obligation is correct? A. The ability to repay rule still applies. The creditor must make a reasonable, good faith determination using verified and documented income, assets, debts, and obligations. Only QM's presumption of compliance is lost. B. Because the loan is non-QM, the ability to repay rule does not apply to it. C. The loan automatically becomes a higher-priced mortgage loan subject to a hard 43% debt-to-income limit. D. Non-QM loans are prohibited on owner-occupied dwellings.
The answer is A. The ability to repay rule still applies. The creditor must make a reasonable, good faith determination using verified and documented income, assets, debts, and obligations. Only QM's presumption of compliance is lost. Ability to repay applies to virtually every closed-end consumer loan secured by a dwelling. Qualified mortgage is merely a subset that earns a safe harbor or rebuttable presumption of compliance.
Question 53. An ARM has a note rate of 4.25% during the initial period. The loan documents state a margin of 2.25%, and at the time of application, the index stands at 5.10%. Which statement is correct? A. The margin will adjust at each change date along with the index. B. The fully indexed rate is 7.35%. The margin stays fixed for the life of the loan while the index moves. C. The fully indexed rate is 4.25% because that is the rate stated on the note. D. The fully indexed rate is 2.85%, found by subtracting the margin from the index.
The answer is B. The fully indexed rate is 7.35%. The margin stays fixed for the life of the loan while the index moves. The fully indexed rate equals the index plus the margin 5. 10% plus 2. 25% equals 7.35%.
Question 54. A 5/1 ARM closed with an initial note rate of 3.50%, a margin of 2.75%, and caps of 2/2/5. At the first adjustment date, the index is 6.00%. What is the borrower's new interest rate? A. 8.50%, B. 8.75%, C. 5.50%, D. 6.25%.
The answer is C. 5.50%. Caps are read left to right as initial/periodic/lifetime, so the first adjustment is limited to 2 percentage points above the 3.50% start rate or 5.50%.
Question 55. An ARM originated with a note rate of 4.00% carries caps of 5/2/5. After several adjustments, the current rate is 9.00%, and at the next change date, the index plus margin equals 11.50%. What is the highest rate the loan may reach at that adjustment? A. 9.00%. The loan is already at its ceiling. B. 11.50%. C. 14.00%. D. 11.00%.
The answer is A. 9.00%. The loan is already at its ceiling. The lifetime cap is measured from the original note rate, not from the current rate, so the ceiling is 4.00% plus 5 equals 9.00%.
Question 56. Under the 2006 Interagency Guidance on Non-Traditional Mortgage Product Risks, how should a lender qualify a borrower for a payment option, ARM, that allows a minimum payment smaller than the accrued interest? A. Using the minimum payment available during the first year. B. Using the initial discounted rate with an interest-only payment. C. Using the lifetime cap rate with an interest-only payment. D. Using the fully indexed rate with a fully amortizing payment.
The answer is D. Using the fully indexed rate with a fully amortizing payment. When the payment does not cover accrued interest, the shortfall is added to principal, negative amortization. So the balance grows and the eventual recast payment can jump sharply.
Question 57. A 71-year-old homeowner is considering an FHA-insured HECM on the primary residence she has owned for 20 years. Her adult children ask what happens if the loan balance eventually grows larger than the home is worth. Which statement is accurate? A. The borrower must make monthly principal and interest payments, or the loan becomes immediately due. B. The heirs are personally liable for any shortfall between the loan balance and the sale price. C. The required HUD-approved counseling may be waived if the borrower is working with a financial advisor. D. A HECM is non-recourse. When the loan becomes due and the home is sold, the amount that must be repaid from the property is limited to the lesser of the loan balance or the home's value.
The answer is D. A HECM is non-recourse. When the loan becomes due and the home is sold, the amount that must be repaid from the property is limited to the lesser of the loan balance or the home's value. A HECM is non-recourse by regulation. Repayment is limited to the property's value at sale, and the FHA Insurance Fund, supported by the HECM mortgage insurance premiums, absorbs any shortfall, so neither the borrower nor the heirs owe the difference.
Question 58. A borrower is offered a home equity line of credit with a 10-year draw period followed by a 15-year repayment period. Which statement accurately describes how this product works? A. The interest rate on a HELOC is fixed for the life of the plan. B. During the draw period, the borrower may advance and repay repeatedly, often with interest-only payments. Once the draw period ends, no new advances are permitted, and the balance is repaid over the repayment period. C. The entire outstanding balance is due in full on the last day of the draw period. D. A HELOC is a closed-end loan dispersed in a single lump sum at closing.
The answer is B. During the draw period, the borrower may advance and repay repeatedly, often with interest-only payments. Once the draw period ends, no new advances are permitted, and the balance is repaid over the repayment period. A HELOC is open-end revolving credit secured by the dwelling and governed by Regulation Z's open-end rules, with a variable rate usually tied to a published index such as prime.
Question 59. A seller agrees to fund a 2-1 temporary buydown on a 30-year fixed-rate loan with a note rate of 6.5%. The subsidy is deposited into an escrowed buydown account at closing. Which statement is accurate? A. The unpaid difference is added to the loan balance each month, creating negative amortization. B. The note rate is permanently reduced to 4.5% for the life of the loan. C. The borrower's payment is calculated as if the rate were 4.5% in year 1 and 5% in year 2, with the difference drawn from the buydown account. The note rate remains 6.5% and the loan balance is unaffected. D. A 2-1 buydown and paying 2 discount points produce the same result for the borrower.
The answer is C. The borrower's payment is calculated as if the rate were 4.5% in year 1 and 5% in year 2, with the difference drawn from the buydown account. The note rate remains 6.5% and the loan balance is unaffected. A temporary buydown is a subsidy arrangement, not a change to the loan. Escrowed funds supplement the borrower's reduced payment in years 1 and 2. Then the payment steps up to the full note rate payment in year 3.
Question 60. A buyer purchases a home for $500,000 that appraises at $510,000. The financing is a $400,000 first mortgage plus a home equity line of credit with a $50,000 credit line, of which $20,000 is drawn at closing. What are the LTV, CLTV, and HCLTV? A. LTV 80%, CLTV 90%, HCLTV 84%. B. LTV 78, 4%, CLTV 82, 4%, HCLTV 88, 2%. C. LTV 84%, CLTV 90%, HCLTV 90%. D. LTV 80%, CLTV 84%, HCLTV 90%.
The answer is D. LTV 80%, CLTV 84%, HCLTV 90%. All three ratios use the lesser of sales price or appraised value as the denominator. Here $500,000, not the $510,000 appraisal.
Question 61. A borrower's gross monthly income is $7,200. The proposed housing payment is $1,908, principal and interest $1,520, property taxes $250, hazard insurance $90, HOA dues $48. Other recurring monthly obligations are a car payment of $420, a student loan payment of $180, and a credit card minimum of $60. What are the housing front-end and total debt back-end ratios? A. 21, 1% and 35, 7%. B. 35, 7% and 26, 5%. C. 26, 5% and 35, 7%. D. 26, 5% and 30, 8%.
The answer is C. 26, 5% and 35, 7%. The housing ratio uses the full housing payment, principal, interest, taxes, insurance, and any HOA dues over gross monthly income. $1, 908 divided by $7, 200 equals 26, 5%.
Question 62. $265,000 loan at 6.00% closes on September 20, with the first payment due November 1. The lender uses a 365-day year and collects interest from and including the day of closing through the end of the month. How much prepaid per diem interest is collected at closing? A. $522, 74. B. $441, 67. C. $435, 62. D. $479, 18.
The answer is D. $479, 18. Per diem interest equals loan amount times rate divided by 365. $265, 000 times 0. 06 equals $15. 900 divided by 365 equals $43. 5,616 per day.
Question 63. A buyer is purchasing a home for $335,000 with a loan amount of $320,000. The lender offers to reduce the monthly payment by $52 in exchange for 5 discount points paid at closing. What is the cost of the points, and approximately how long is the break-even period? A. $4, 800 and approximately 46 months. B. $4, 800 and approximately 92 months. C. $5, 025 and approximately 97 months. D. $3, 200 and approximately 62 months.
The answer is B. $4, 800 and approximately 92 months. 1 point equals 1% of the loan amount, not the sales price, so 5 points on $320, 000 is $4, 800 the 5, 025 answer wrongly uses the $335, 000 price.
Question 64. Which of the following charges is not included in the finance charge, and therefore is not reflected in the annual percentage rate? A. Prepaid per diem interest collected at closing. B. The loan origination fee charged by the creditor. C. Discount points paid to reduce the interest rate. D. The appraisal fee paid to an independent appraiser.
The answer is D. The appraisal fee paid to an independent appraiser. The finance charge is the cost of consumer credit expressed as a dollar amount, and Regulation Z expressly excludes certain real estate-related third-party fees. Appraisal, credit report, title examination and title insurance, document preparation by a third party, notary and recording fees, when they are bona fide and reasonable.
Question 65. An MLO is explaining the secondary market to a borrower. Which statement correctly describes Ginnie Mee's role? A. Ginnie Mee guarantees the timely payment of principal and interest on mortgage-backed securities backed by government-insured or guaranteed loans. It does not originate or purchase loans. B. Ginnie Mee insures individual FHA loans against borrower default. C. Ginnie Mee purchases conventional conforming loans in the same way Fannie Mae does. D. Ginnie Mee is a shareholder-owned private corporation that securitizes jumbo loans.
The answer is A. Ginnie Mee guarantees the timely payment of principal and interest on mortgage-backed securities backed by government-insured or guaranteed loans. It does not originate or purchase loans. Ginnie Mee is a wholly government-owned corporation within HUD whose only function is to place the full faith and credit guarantee of the United States on MBS issued by approved issuers and backed by FHA, VA, USDA, and PIH loans.
Question 66. A homeowner is doing a rate-an term refinance of the first mortgage. An existing HELOC, recorded after the original first mortgage, will remain in place. What must happen for the new loan to close in first lien position? A. The new lender must require the HELOC to be paid off and closed. Subordination is not available on a rate-an term refinance. B. Nothing. The HELOC remains automatically subordinate because it was recorded second in the first place. C. The HELOC lender must sign a subordination agreement that is recorded with the new mortgage. Otherwise, the HELOC would advance to first position when the old first mortgage is paid off and released. D. Lien priority follows loan size, so the larger new mortgage automatically takes first position.
The answer is C. The HELOC lender must sign a subordination agreement that is recorded with the new mortgage. Otherwise, the HELOC would advance to first position when the old first mortgage is paid off and released. Lien priority is generally first in time, first in right based on recording order. So when the original first mortgage is paid off and its lien released, the previously junior HELOC moves up automatically.
Question 67. A prospective borrower emails a loan originator her name, her monthly income, her social security number, the address of the property she wants to buy, her own estimate of the property's value, and the loan amount she is seeking. The originator replies that he cannot start the file until she signs an intent to proceed form and sends 2 pay stubs. Which statement is correct? A. No application exists until the consumer provides pay stubs verifying her income. B. An application exists only after the consumer has paid the appraisal fee. C. An application has already been received. All 6 required items are present, and the creditor may not require verification documents before issuing the loan estimate. D. No application exists until the consumer signs a statement of intent to proceed.
The answer is C. An application has already been received. All 6 required items are present, and the creditor may not require verification documents before issuing the loan estimate. An application exists the moment the creditor receives 6 items: consumer name, income, social security number to pull credit, property address, an estimate of property value, and the mortgage loan amount sought, and no 7th item may be added to that list.
Question 68. A consumer's 6 application items are received on Monday. The originator has not yet delivered the loan estimate, but wants to collect a $500 appraisal fee so the appraisal can be ordered immediately. What may the originator do? A. Collect no fee other than a bona fide and reasonable charge for the credit report until the consumer has received the loan estimate and indicated intent to proceed. B. Collect the appraisal fee now because the consumer authorized it verbally. C. Treat 3 business days of silence after delivery of the loan estimate as the consumer's intent to proceed, then collect. D. Collect the appraisal fee as long as it is refundable if the loan does not close.
The answer is A. Collect no fee other than a bona fide and reasonable charge for the credit report until the consumer has received the loan estimate and indicated intent to proceed. Reg Z permits only a bona fide and reasonable fee for obtaining the consumer's credit report before the consumer has received the loan estimate and affirmatively indicated intent to proceed. All other fees, including appraisal fees, must wait.
Question 69. Which information is captured in the final section of the Uniform Residential Loan Application? A. The schedule of real estate the borrower already owns. B. The borrower's declarations about intended occupancy and prior property ownership. C. The applicant's demographic government monitoring information. D. the loan originator's name and NMLS unique identifier together with the originating organization's NMLS identifier?
The answer is D. The loan originator's name and NMLS unique identifier together with the originating organization's NMLS identifier. The loan originator information section closes the application and must identify the individual originator by name and NMLS unique identifier, and the originating company by its NMLS identifier, so the loan can be traced to a licensed or registered originator.
Question 70. An applicant completes an application face-to-face in the originator's office and declines to provide ethnicity, race, and sex on the demographic information addendum. What must the originator do? A. Note that the applicant declined and record ethnicity, race, and sex on the basis of visual observation or surname. B. Tell the applicant the information is mandatory and that the application cannot proceed without it. C. Obtain the information from the co-applicant or from a public record. D. Leave the fields blank and simply note that the applicant refused.
The answer is A. Note that the applicant declined and record ethnicity, race, and sex on the basis of visual observation or surname. For applications taken in person including by video with visual contact, the rule requires the originator both to note the applicant's refusal and to record ethnicity, race, and sex based on visual observation or surname, so that monitoring data are not lost.
Question 71. During a face-to-face interview with a 34-year-old female applicant, which inquiry is permissible under Regulation B? A. The applicant's religious affiliation, to gauge community ties. B. Whether the applicant receives alimony. Asked before telling her, it need not be revealed unless she wants it considered. C. The applicant's age, so long as age is not used to discount or disfavor the application. D. Whether the applicant and her spouse intend to have more children.
The answer is C. The applicant's age, so long as age is not used to discount or disfavor the application. Regulation B allows a creditor to ask an applicant's age because age is needed to determine capacity to contract and may be used only in an empirically derived, demonstrably sound scoring system or to favor an elderly applicant.
Question 72. An underwriter reviews 2 months of bank statements showing $28,000 that will remain after the down payment and closing costs are paid. This documentation primarily supports which of the 4 Cs of underwriting? A. Capacity. B. Credit. C. Collateral. D. Capital.
The answer is D. Capital. Capital refers to the borrower's own funds, down payment, closing costs, and post-closing reserves, and is documented by sourced and seasoned asset statements.
Question 73. A retired applicant receives $1,200 per month in non-taxable Social Security benefits. How should the underwriter treat this income? A. It must be excluded because the borrower has no employment income. B. It may be counted only if the borrower also has wage income. C. It may be counted at face value, and because it is non-taxable, adjusted upward, grossed up by the percentage the investor's guidelines allow, provided continuance is documented. D. It may be counted only after being reduced by an assumed tax rate.
The answer is C. It may be counted at face value, and because it is non-taxable, adjusted upward, grossed up by the percentage the investor's guidelines allow, provided continuance is documented. Qualifying income need not come from employment. It must be stable, verified, and reasonably expected to continue, which is why award letters and benefit statements are collected.
Question 74. A borrower is short on down payment funds. the seller's listing agent offers to gift $5,000, and the proposed gift letter states that the borrower will take care of the agent after closing. How should the originator treat this? A. Acceptable if the gift letter is notarized. B. Acceptable if the $5,000 is disclosed on the application as other income. C. Acceptable if the funds are wired directly to the settlement agent rather than to the borrower. D. Unacceptable. The donor is an interested party to the transaction, and gift funds may not carry any expectation of repayment.
The answer is D. Unacceptable. The donor is an interested party to the transaction, and gift funds may not carry any expectation of repayment. A valid gift letter must state the amount, the donor's name and relationship to the borrower, and that no repayment is expected. Any repayment expectation converts the money into an undisclosed, unsecured debt that distorts the debt ratio.
Question 75. A processor hands the borrower a blank verification of deposit form and asks him to take it to his bank and bring the completed form back to the office. Which statement is correct? A. Improper only when the loan is a government-insured loan. B. Acceptable if the depository stamps and signs the form. C. Improper. Third-party verifications must travel directly from the lender to the verifying party and back, never through the borrower's hands. D. Acceptable, as long as the borrower does not open the sealed envelope.
The answer is C. Improper third-party verifications must travel directly from the lender to the verifying party and back, never through the borrower's hands. The evidentiary value of a verification of deposit or verification of employment depends on it coming from an independent third party without the borrower's involvement, so it must be sent and returned directly between the lender and the depository or employer.
Question 76. A joint application is submitted. Borrower A's tri-merge scores are 704, 688, and 712. Borrower B's are 660, 672, and 651. Under the Standard Agency Convention, what is the representative credit score for the file? A. 672. B. 660. C. 651. D. 704.
The answer is B. 660. For each borrower with 3 scores, the representative score is the middle score, 704 for borrower and 660 for borrower B, not the average and not the high or low score.
Question 77. An automated underwriting system returns an approve/eligible recommendation with reduced documentation. What does that recommendation mean? A. It is a recommendation generated entirely from the data entered. The file must still be documented as the findings direct, every condition cleared, and the data verified. Inaccurate input voids the finding. B. The loan is approved, and no further documentation of income or assets is needed. C. It confirms that the appraisal will support the value used in the application. D. The recommendation by itself satisfies the ability to repay requirement.
The answer is A. It is a recommendation generated entirely from the data entered. The file must still be documented as the findings direct, every condition cleared, and the data verified. Inaccurate input voids the finding. An AUS evaluates only the data keyed into it, so its recommendation is conditional. The documentation the findings require must be obtained, all conditions cleared to close, and the entered data verified, and any material variance invalidates the recommendation.
Question 78. Which of the following is not among the minimum factors a creditor must consider and verify under the ability to repay rule? A. The equity in the dwelling that the creditor could recover if the consumer defaulted. B. The consumer's monthly debt-to-income ratio or residual income. C. The consumer's monthly payment for mortgage-related obligations, such as property taxes and insurance. D. The monthly payment on any simultaneous loan the creditor knows or has reason to know about.
The answer is A. The equity in the dwelling that the creditor could recover if the consumer defaulted. The ability to repay rule requires the creditor to look at repayment capacity from income or assets other than the value of the dwelling securing the loan, precisely to stop collateral-based lending.
Question 79. Under the General Qualified Mortgage Standard, which loan feature is permitted? A. A payment schedule that permits the principal balance to increase. B. A period during which the consumer pays interest only. C. A 30-year term with fully amortizing, substantially equal payments. D. A balloon payment due at the end of the term.
The answer is C. A 30-year term with fully amortizing, substantially equal payments. A qualified mortgage may not contain negative amortization, interest-only payments, or a balloon payment, and its term may not exceed 30 years. These product restrictions exist because such features mask payment shock.
Question 80. Which action by a lender's staff is permitted under the appraisal valuation independence rules? A. Withholding the appraiser's payment until the value is reconsidered. B. Telling the appraiser the value the file needs in order to close. C. Asking the appraiser to correct an objective factual error and to consider additional comparable sales. D. Removing an appraiser from the panel because a report came in below the contract price.
The answer is C. Asking the appraiser to correct an objective factual error and to consider additional comparable sales. Valuation independence prohibits coercing, bribing, intimidating, instructing, or inducing an appraiser to reach a predetermined value, including withholding payment or future assignments, or selecting appraisers by the values they deliver.
Question 81. On a single-family residence, the sales comparison approach is given the greatest weight. A comparable sale has 3 full bathrooms while the subject has 2. How does the appraiser handle the difference? A. Average the values indicated by the 3 approaches to reach the final opinion. B. Add the value of a bathroom to the subject property's indicated value. C. Subtract the contributory value of the extra bathroom from the comparable sale price. D. Subtract the value of a bathroom from the subject property.
The answer is C. Subtract the contributory value of the extra bathroom from the comparable sale price. In the sales comparison approach, all adjustments are made to the comparables, never to the subject, because the subject's value is the unknown being estimated. Subtract from a comparable that is superior and add to one that is inferior.
Question 82. A federally related loan is secured by a home located in a special flood hazard area. How much flood insurance must the lender require? A. The sales price of the property. B. The full appraised value of the property, including the land. C. The lesser of the outstanding principal balance of the loan, the insurable value of the improvements, or the maximum coverage available under the NFIP. D. None. Coverage is optional if the borrower signs a hold harmless waiver.
The answer is C. The lesser of the outstanding principal balance of the loan, the insurable value of the improvements, or the maximum coverage available under the NFIP. Flood coverage is mandatory, not waivable. Once a standard flood hazard determination places the building in a special flood hazard area, and the required amount is the lesser of the outstanding principal balance, the insurable value of the improvements, or the maximum NFIP limit.
Question 83. A borrower is refinancing the mortgage on her principal residence with a lender other than her current creditor and is taking cash out. Which statement about the right of rescission is correct? A. The right runs for 7 business days from consummation. B. The right of rescission applies to purchase money loans on a principal residence as well. C. She has 3 business days, counting Saturdays but not Sundays or federal legal holidays, measured from the latest of consummation, delivery of the material disclosures, or receipt of 2 copies of the notice of right to cancel, and no funds may be disbursed until that period expires. D. There is no right of rescission because refinances are exempt.
The answer is C. She has 3 business days, counting Saturdays but not Sundays or federal legal holidays, measured from the latest of consummation, delivery of the material disclosures, or receipt of 2 copies of the notice of right to cancel, and no funds may be disbursed until that period expires. Rescission attaches to refinances with a new creditor, home equity loans, and HELEC secured by the consumer's principal dwelling, but never to purchase money loans. A same creditor refinance is rescindable only as to any new money advanced.
Question 84. A home has a contract sales price of $320,000 and an appraised value of $330,000. The first mortgage is $256,000, and the borrower is also taking a simultaneous second lien of $16,000. What are the LTV and CLTV? A. LTV 85%, CLTV 80%. B. LTV 77, 58%, CLTV 82, 42%. C. LTV 80%, CLTV 80%. D. LTV 80%, CLTV 85%.
The answer is D. LTV 80%, CLTV 85%. Loan-to-value is the loan amount divided by the lesser of sales price or appraised value. So the divisor is $320,000, not $330,000. $256,000 divided by $320,000 equals 80%.
Question 85. A borrower's gross monthly income is $7,500. The proposed housing payment is $1,650 principal and interest, $250 property taxes, $100 hazard insurance, and $100 HOA dues. Recurring obligations are a $420 car payment with 32 payments remaining, a $180 student loan payment, $95 in credit card minimums, $300 in court-ordered child support, and a $250 personal loan payment with 8 payments remaining. Applying the convention that an installment debt with fewer than 10 payments remaining is excluded, what are the housing front-end and total back-end ratios? A. 28.00% and 44.60%. B. 26, 67% and 39.93%. C. 28.00% and 41.27%. D. 22.00% and 41.27%.
The answer is C. 28.00% and 41.27%. The housing ratio uses the full PD plus HOA. $1, 650 plus $250 plus $100 plus $100 equals $2, 100 divided by $7, 500 equals 28.00%.
Question 86. An applicant earns $24.00 per hour for a guaranteed 40 hours per week. Verified overtime was $3,600 over the most recent 12 months and $2,400 over the prior 12 months, and the employer confirms overtime is likely to continue. What is the qualifying gross monthly income? A. $4,160. B. $4,410. C. $4,090. D. $4,460.
The answer is B. $4,410. Hourly base income is annualized and divided by 12. $24. 00 times 40 hours times 52 weeks equals $49. 920 divided by 12 equals $4. 160 per month.
Question 87. $250, 000 loan at 6. 0% interest disburses on March 20. The lender collects prepaid interest from the disbursement date through the last day of the month using a 365-day year. How much prepaid per diem interest is collected? A. $493, 15. B. $452, 05. C. $500, 00. D. $250, 00.
The answer is A. $493, 15. The daily rate is the loan amount times the annual rate divided by the stated day count. $250, 000 times 0. 06 equals $15. 000 divided by 365 equals $41. 0959 per day.
Question 88. A home sells for $410, 000, and the borrower makes a 20% down payment. The lender charges a 1% origination fee plus 5 discount points. What is the total dollar amount of the origination fee and discount points? A. $10, 250. B. $3, 280. C. $4, 920. D. $8, 200.
The answer is D. $8, 200. Points are always a percentage of the loan amount, not the sales price.
Question 89. An applicant with 3 young children asks about a condominium loan. The MLO responds, honestly, the lender would rather not place families with small kids in that project. Which federal statute's protected class does this remark most directly implicate? A. HOEPA and Regulation B, because familial status is one of Regulation B's prohibited bases. B. HOEPA only, because the remark concerns the applicant's marital status. C. No federal law, because families with children are not a protected group in mortgage lending. D. The Fair Housing Act, because familial status is a protected class under that statute.
The answer is D. The Fair Housing Act, because familial status is a protected class under that statute. Familial status households with children under 18 and pregnant persons or those obtaining custody is protected by the Fair Housing Act, not by HOEPA.
Question 90. A lender adopts a policy of not originating any mortgage below a set minimum loan amount. The policy is applied to every applicant without exception, but in practice, it screens out nearly all applicants from one predominantly minority neighborhood of modestly priced homes. There is no evidence of intent to exclude anyone. How is this best characterized? A. Disparate impact, because a facially neutral policy disproportionately burdens a protected class and no intent is required. B. Redlining, which is established only by proving the lender intended to avoid the neighborhood. C. No fair lending issue, because the policy is applied identically to every applicant. D. Disparate treatment, because a protected class was intentionally singled out.
The answer is A. Disparate impact, because a facially neutral policy disproportionately burdens a protected class and no intent is required. Disparate impact arises when a facially neutral, uniformly applied policy produces a disproportionately adverse effect on a protected class and cannot be justified by business necessity or achieved through a less discriminatory alternative.
Question 91. A mortgage company actively solicits in a predominantly Hispanic neighborhood, but in that neighborhood, it markets only a high-rate product carrying elevated origination fees and a prepayment penalty, while offering its standard-priced products in surrounding neighborhoods to similarly qualified borrowers. This practice is best described as A. Lawful risk-based pricing, because credit was in fact extended in the neighborhood. B. Redlining. C. Reverse redlining. D. Blockbusting.
The answer is C. Reverse redlining. Reverse redlining is the targeting of a protected neighborhood with predatory or materially more expensive terms. Redlining is the opposite, refusing or discouraging lending in an area because of its racial or ethnic composition.
Question 92. A woman calls about a purchase loan. She is on paid parental leave, and her employer has provided written verification of her guaranteed return date and the salary she will resume. The MLO tells her, "Call me back once you're actually back at work," and does not take an application. This is A. Proper, because the applicant is not receiving her full salary on the date of application. B. A violation of HOEPA/Regulation B. The MLO discouraged an application on a prohibited basis and must take the application and evaluate the documented return-to-work income. C. A violation of the Fair Housing Act only, because HOEPA does not reach parental leave. D. Proper, provided the MLO documents that no application was ever taken.
The answer is B. A violation of HOEPA/Regulation B. The MLO discouraged an application on a prohibited basis and must take the application and evaluate the documented return-to-work income. Regulation B prohibits a creditor from making any oral or written statement that would discourage a reasonable person from pursuing an application. And discrimination on the basis of sex includes treating an applicant unfavorably because she is on maternity or parental leave.
Question 93. An applicant's qualifying income consists partly of long-term, verifiable public assistance benefits. The MLO tells her, "We can't use that kind of income, so there's really no point in you applying." Which statement is correct? A. It is acceptable, because public assistance income is never guaranteed to continue. B. It violates HOEPA, which forbids discrimination, because all or part of an applicant's income derives from a public assistance program. Verified, reliable public assistance income must be considered. C. It violates the Fair Housing Act, which lists receipt of public assistance as a protected class. D. It is acceptable so long as the lender treats every public assistance recipient the same way.
The answer is B. It violates HOEPA, which forbids discrimination because all or part of an applicant's income derives from a public assistance program. Verified, reliable public assistance income must be considered. Receipt of income from any public assistance program is an HOEPA-prohibited basis, and Regulation B requires a creditor to consider such income to the extent of its likely continuance, exactly as it would any other income.
Question 94. During a face-to-face application for a loan secured by a dwelling, the applicant declines to provide her ethnicity, race, and sex for government monitoring purposes. What must the MLO do? A. Note that the applicant declined and complete ethnicity, race, and sex on the basis of visual observation or surname. B. Ask the applicant to pick any category so that the file is complete. C. Leave the ethnicity, race, and sex fields blank, and simply note that the applicant refused. D. Hold the application without processing it until the applicant supplies the information.
The answer is A. Note that the applicant declined and complete ethnicity, race, and sex on the basis of visual observation or surname. For dwelling-secured applications taken face-to-face, including by video, Regulation B requires the creditor to note that the applicant declined, and then to record ethnicity, race, and sex on the basis of visual observation or surname.
Question 95. Which of the following requires the creditor to send an adverse action notice under Regulation B? A. An application missing income verification, for which the creditor sends a notice of incompleteness. B. A counteroffer for a smaller loan amount that the applicant accepts and closes. C. An application the applicant withdraws before the creditor makes any decision. D. A denial of the application as submitted, where the applicant accepts no counteroffer.
The answer is D. A denial of the application as submitted, where the applicant accepts no counteroffer. Adverse action means a denial, a termination, or an unfavorable change in the terms of an existing account. A counteroffer that the applicant accepts is not adverse action. An incomplete application is handled with a notice of incompleteness, and a withdrawal is not a creditor decision.
Question 96. An MLO agrees to pay the full cost of a real estate agent's monthly newspaper advertisement, which features only the agent's own listings and does not mention the MLO. In exchange, the agent sends the MLO her buyer clients. Under RESPA, this arrangement is A. Permitted, as long as the payment is itemized on the borrower's closing disclosure. B. Prohibited. Paying the agent's advertising cost is a thing of value given pursuant to an understanding that settlement business will be referred, and both the giver and the receiver are liable. C. Permitted, because the MLO paid a third-party publisher rather than paying the agent directly. D. Permitted, because normal promotional and educational activities are accepted from Section 8.
The answer is B. Prohibited. Paying the agent's advertising cost is a thing of value given pursuant to an understanding that settlement business will be referred, and both the giver and the receiver are liable. RESPA Section 8. A bars giving or accepting any fee, kickback, or thing of value pursuant to any agreement or understanding, oral or otherwise, that settlement service business on a federally related mortgage loan be referred.
Question 97. Which of the following payments falls within a recognized RESPA Section 8 exception and is therefore permitted? A. An MLO gives the closing agent gift cards each quarter to thank her for the closings she refers. B. An MLO rents a desk inside a real estate office at twice the market rent for comparable space. C. A mortgage lender pays its own salaried employee a bonus for referring customers to the employer. D. A title agency pays a real estate brokerage a set monthly amount for each buyer the brokerage sends it.
The answer is C. A mortgage lender pays its own salaried employee a bonus for referring customers to the employer. Section 8(c) expressly permits an employer's payment to its own employees for referral activities, because the referral fee stays inside the employment relationship rather than flowing to an outside settlement service provider.
Question 98. A mortgage broker orders a tri-merge credit report from the Bureau and charges the borrower an amount noticeably higher than what the Bureau charged the broker, keeping the difference as additional revenue. This is A. Permissible, because the amount is disclosed to the borrower on the loan estimate. B. Prohibited as an unearned fee. Charging more than the actual cost of a third-party service is a markup for which no additional service was performed. C. Permissible, provided the total charge is within the range other brokers charge. D. Permissible, because credit reporting charges fall outside the scope of RESPA.
The answer is B. Prohibited as an unearned fee. Charging more than the actual cost of a third-party service is a markup for which no additional service was performed. RESPA Section 8b prohibits accepting any portion of a charge for a settlement service other than for services actually performed, and the implementing rule treats marking up a third-party charge without providing additional services as an unearned fee.
Question 99. A mortgage brokerage and a title agency are under common ownership, and the brokerage routinely refers its borrowers to the affiliated title agency. The arrangement qualifies as a permissible affiliated business arrangement only if A. the referral relationship is disclosed to the borrower at the closing table. B. The relationship is disclosed at or before the time of referral. The borrower is not required to use the affiliate, and the only thing of value received is a return on ownership interest. C. The affiliate pays the referring company an amount above market value, and both companies hold the required licenses. D. The borrower is required to use the affiliate in order to receive a rate discount.
The answer is B. The relationship is disclosed at or before the time of referral. The borrower is not required to use the affiliate, and the only thing of value received is a return on ownership interest. RESPA permits an affiliated business arrangement only when written disclosure of the relationship and an estimate of the affiliate's charges is given at or before the referral. The consumer is not required to use the affiliate. Narrow exceptions exist for an attorney, credit reporting agency, or appraiser selected by the lender, and the sole thing of value received is a return on ownership interest.
Question 100. Under Regulation Z's Loan Originator Compensation Rule, which of the following is a permissible basis for paying an individual loan originator? A. A higher percentage on loans that carry a higher loan-to-value ratio. B. A fixed percentage of the loan amount, subject to a stated minimum and maximum dollar amount. C. An extra payment on loans that include a prepayment penalty. D. A bonus tied to how far above par the borrower's interest rate is set.
The answer is B. A fixed percentage of the loan amount, subject to a stated minimum and maximum dollar amount. Compensation may not be based on a term of the transaction or on a proxy for a term, a factor that consistently varies with a term over many transactions and that the originator can manipulate.
Question 101. A borrower pays a mortgage broker's origination fee directly out of pocket at closing. The creditor then offers to pay the same broker an additional commission on that same loan. Under Regulation Z, this is A. Prohibited. When the consumer pays the loan originator directly, no other person may compensate that originator on the same transaction. B. Permitted, if the total compensation is reasonable for the market. C. Permitted, if both payments appear on the closing disclosure. D. Permitted, if the borrower signs a written consent to both payments.
The answer is A. Prohibited. When the consumer pays the loan originator directly, no other person may compensate that originator on the same transaction. The dual compensation prohibition is absolute. If the consumer pays the loan originator directly, no creditor or other person may also compensate that originator in connection with the same transaction, and an originator compensated by the creditor may not also collect from the consumer.
Question 102. A consumer tells an MLO she wants to compare both fixed rate and adjustable rate options. To fall within Regulation Z's anti-steering safe harbor, the MLO must present A. For each type of transaction in which the consumer expressed interest, at least 3 options: the lowest interest rate without risky features, and the lowest total dollar amount of discount points, origination points, and origination fees. B. 3 options in total, drawn from whichever product type is easiest to approve. C. For the fixed rate request only: the lowest rate, the second lowest rate, and the lowest monthly payment. D. 3 options showing the lowest closing costs, the lowest APRA, and the smallest down payment.
The answer is A. For each type of transaction in which the consumer expressed interest, at least 3 options: the lowest interest rate without risky features, and the lowest total dollar amount of discount points, origination points, and origination fees. The safe harbor requires the 3 specified options for each transaction type the consumer expressed interest in, obtained from a significant number of the creditors with whom the originator regularly does business, and the originator must have a good faith belief the consumer likely qualifies for them.
Question 103. An appraisal comes in below the contract price, and the MLO wants to contact the appraiser. Which communication is permitted under the appraiser independence requirements? A. Telling the appraiser what value the file needs in order for the loan to close. B. Asking the appraiser to consider additional comparable sales and to correct an objective factual error in the report. C. Reminding the appraiser that future assignments depend on supporting the contract price. D. Advising the appraiser that payment will be released only once the value is revised upward.
The answer is B. Asking the appraiser to consider additional comparable sales and to correct an objective factual error in the report. TILA appraiser independence rule bars coercion, bribery, intimidation, compensation manipulation, or any inducement intended to cause an appraiser to reach a predetermined value, which is exactly what a target value, a withheld fee, or a threat about future work amounts to.
Question 104. A wage earner inflates his stated income and submits an altered pay stub so that he can qualify for a home he and his family will move into. No MLO, appraiser, or closing agent is involved in the deception. This is best classified as A. Fraud for housing, fraud for property, because the borrower misrepresented in order to obtain a residence he intends to occupy. B. Occupancy fraud, because the misrepresentation relates to the subject property. C. Not fraud at all, because the borrower fully intends to make every payment. D. Fraud for profit, because a lender always loses money when a loan is misrepresented.
The answer is A. Fraud for housing, fraud for property, because the borrower misrepresented in order to obtain a residence he intends to occupy. Fraud for housing, fraud for property is committed by a borrower who misstates income, assets, employment, or debts to obtain a home he genuinely intends to occupy, while fraud for profit involves insiders conspiring to extract money from the transaction.
Question 105. An MLO, an appraiser, and a closing agent arrange for a credit-worthy cousin to apply and take title to a property, although the real purchaser, who could not qualify, will occupy it, control it, and receive cash disbursed at closing. This scheme is best identified as A. A straw buyer scheme, a form of fraud for profit. B. A silent second. C. Fraud for housing. D. An heir loan.
The answer is A. A straw buyer scheme, a form of fraud for profit. A straw buyer scheme uses a credit-worthy person's name and credit to front for a hidden true purchaser, and the participation of industry insiders who extract cash from the closing makes it fraud for profit.
Question 106. While reviewing a file, an MLO notices that the fonts on the borrower's W-2 differ between pages. The employer's address is a mailbox rental store, and the verification of employment phone number rings a personal cell phone. What is the MLO's best course of action? A. Quietly withdraw the application without documenting or reporting the concerns. B. Ask the borrower to bring in a cleaner copy of the W-2 and keep processing the file. C. Stop, decline to submit the file, and escalate the findings to the company's compliance or fraud unit under its written procedures. D. Submit the file and let the underwriter decide whether the documents are genuine.
The answer is C. Stop, decline to submit the file, and escalate the findings to the company's compliance or fraud unit under its written procedures. Inconsistent document formatting, a mail drop employer address, and a verification number answering as a personal cell are classic fraud red flags, and knowingly submitting false information to a federally insured lender is a federal crime.
Question 107. After the company files a suspicious activity report concerning a borrower's transaction, the borrower calls the MLO and demands to know why his file has stalled. The MLO must A. Tell the borrower his file was flagged, so that he has a chance to supply corrected documents. B. Disclose nothing about the report to the borrower or to anyone else not authorized, because revealing a SAR or its existence is itself a federal violation. C. Tell the borrower a report was filed, since the information concerns him. D. Tell the borrower's real estate agent, but not the borrower himself.
The answer is B. Disclose nothing about the report to the borrower or to anyone else not authorized, because revealing a SAR or its existence is itself a federal violation. A suspicious activity report and any information that would reveal its existence is confidential by federal law, so tipping off the subject, or anyone not authorized to know, is a separate offense independent of the underlying suspicion.
Question 108. A residential mortgage lender's compliance officer determines that a transaction is reportable as suspicious, but no suspect has yet been identified. What is the filing deadline? A. Within 90 calendar days of initial detection. B. Within 30 calendar days of initial detection. If no suspect has been identified, the deadline may be extended, but filing must occur no later than 60 calendar days after initial detection. C. There is no deadline, provided the report is filed before the loan closes. D. Within 15 business days of initial detection, with no extension available.
The answer is B. Within 30 calendar days of initial detection. If no suspect has been identified, the deadline may be extended, but filing must occur no later than 60 calendar days after initial detection. The BSA rules for loan or finance companies require a suspicious activity report to be filed within 30 calendar days after initial detection of the facts that constitute a basis for filing.
Question 109. A privately owned mortgage brokerage mails a flyer headlined Federal Homeowner Relief Program, Guaranteed Approval, Cut Your Payment in Half. The brokerage has no government affiliation, no approval is guaranteed, and the payment claim is not achievable for most recipients. The flyer is A. Is acceptable, provided the company keeps a copy of the flyer in its advertising file. B. Violates the Mortgage Acts and practices Rule Regulation N, which bars material misrepresentations in commercial communications, including false government affiliation and misleading payment claims. C. Is acceptable puffery, because no specific interest rate is quoted. D. Becomes a concern only if a consumer actually applies and is then denied.
The answer is B. Violates the Mortgage Acts and practices Rule Regulation N, which bars material misrepresentations in commercial communications, including false government affiliation and misleading payment claims. Regulation N prohibits any material misrepresentation in a commercial communication about a mortgage credit product, and it names among the prohibited subjects the amount of the payment, the likelihood of obtaining a loan or modification, and any claim that the product is a government program or is endorsed by or affiliated with a government agency.
Question 110. The buyer's real estate agent calls an MLO and asks for the borrower's credit score, monthly debts, and the reason the file is taking so long. The borrower has signed no authorization to release information to the agent. The MLO should A. Provide the credit score only, since the full report is the confidential item. B. Provide the information, because the agent is a party to the same transaction. C. Decline to release any of it without the borrower's written authorization, because it is non-public personal information and consumer report information. D. Provide the information because the agent is the one who referred the borrower.
The answer is C. Decline to release any of it without the borrower's written authorization, because it is non-public personal information and consumer report information. The Gramm-Leach-Bliley Act and its privacy rule restrict sharing a customer's non-public personal information with non-affiliated third parties. And the Fair Credit Reporting Act allows use or disclosure of consumer report information only for a permissible purpose tied to a transaction the consumer initiated.
Practice every one of these questions free at quibank.com. The link is in the description.